Let's roll. I'm recording.
Effective gross income estimates. After the analysis for determining potential gross income for the subject property has been completed, the next step in the income approach is to determine effective gross income. Effective gross income is the potential gross income less vacancy and collection loss, plus appropriate miscellaneous income. To determine.
Also, miscellaneous income is also called secondary income.
To determine effective gross income, each of the following factors must be considered: vacancy loss, collection loss, and miscellaneous income. Vacancy loss. Because it is highly unlikely that a property will remain fully rented for the entire period of its life, a deduction from potential gross income should be made for the vacancy that is expected to occur. The vacancy factor for any particular property must be determined by studying other comparable properties and analyzing their rental histories, as well as the recent history of vacancies in the subject property. In arriving at the appropriate deduction for vacancy, consideration should be given to the probability of competitive construction in the near future, as well as the present demand for the type of property being appraised. Table 12.2 shows the development of a vacancy rate from a three apartment buildings with a comparable rental units. Am I reading this chart? Okay.
And you're going to do them by columns.
Okay.
The number of occupied units in column A, and read them across.
Okay. Table 12.2, development of vacancy rates for apartment buildings. Number of units, occupied units. A. Oh, no. We need to. You want me? Are you sure?
Subtraction.
You want me to do these by column, not by row? So you're
column.
You want me to say that apartment building A has 120 number of units. It has.
And subtract.
We want to take away the 112 occupied units, which gives it's an 8 units. Leaves 8 vacant units, and you're going to divide that by 120 number of units.
Yeah.
To give you a vacancy loss rate of 0.0667 or 6.7%.
Correct, yeah.
Okay. So then apartment building B has 150 units. Subtract the number of occupied units of 139, leaves vacant units of 11. Divide that by the number of units of 150 equals a vacancy loss rate of 0.0733 or 7.3%. Apartment building C has 160 units, less the number of occupied units, 148, leaves the vacant units as 12, divided by the number of units of 160, leaves the vacancy loss rate 0.0750 or 7.5%. To determine the vacancy percentage, divide the total number of vacant units by the total number of units. The example shows that vacancy for these properties typically runs between 6.7 and 7.5%, and that as a number of units increases, so does the vacancy rate. Because the subject apartment building contains 130 units, the vacancy rate should be between 6.7%. Apartment building A, 120 units, and 7.3% apartment building B, 150 units. Selecting 7% as the vacancy rate for a comparable apartment building with 130 units would be a reasonable conclusion. The deduction for vacancy for the subject property would therefore be 7% of the potential gross income. The deduction for vacancy can be high for old hotels and motels, or low for new, well-located, and well-managed office complexes. As buildings get older, the vacancy rate tends to increase. Physical condition, as well as functional and external obsolescence, normally causes older buildings to be less desirable and less useful. The economic principles of supply and demand change, competition, and substitution confirm this observation. Collection loss. Collection loss is simply the loss that results from the failure of tenants to pay the rent. The two major factors to consider in collection loss are the comparison with comparable properties and the tenants in the subject property. Consider the example in Table 12.3 taken from the operating statements of two comparable properties. A comparison of the information from the operating statements shown that the collection loss is about 1% of billable income. To calculate the collection loss percentage, add the amount of rent collected to the amount of rent uncollected and divide the amount uncollected by the total. The collection loss 1.14% for apartment building A is calculated by dividing $1,750, the rents uncollected, by $153,110 of rents billable. The rents billable total does not include rent for apartments that are vacant. Only the apartments that are occupied and that are expected to produce rent are included in rents billable. Table 12.3, Development of a Collection Loss Rate. Apartment building A has rents billable of $153,110, less the rents collected of $151,360, equals rents uncollected $1,750, then divide that by rents billable $153,110 equals a collection loss rate of 0.0114 or 1.14%.
You can just read the percentages in parentheses.
Okay.
Yeah.
Apartment building B has rents billable of $194,812, less rents collected of $192,740, equals rents uncollected of $2,072, divided by rents billable $194,812, equals a collection loss rate of 1.06%.
Yeah, I think what you're supposed to do, they don't say it right here, but then you add that rate to the vacancy rate, and then, okay, well, go ahead.
Well, I bet that's what they're coming to.
Yeah.
Hold your horses. Hot it. Hot it.
Just hold it right there.
Miscellaneous income. The examples in tables 12.2 and 12.3 indicate a vacancy and collection loss of 8%. Aha.
Mm-hmm.
Vacancy 7%, collection loss 1%. After this total is subtracted from the potential gross income, any miscellaneous income generated from the operation of the property must be added. Miscellaneous income can come from several sources other than actual rent, including parking, resale of utilities, gas, water, electricity, coin-operated laundry, and club room rent. Miscellaneous income is non-scheduled income and is often referred to as service income. The following example shows how effective gross income is calculated. Potential gross income, $125,000, less vacancy and collection loss of 8%, minus $10,000, equals effective gross income from rents, $115,000, plus miscellaneous income, for example, laundry, add $7,500, equals effective gross income of $122,500.
And effective gross is different from potential gross income. Potential gross income is the number of units multiplied by the monthly rent times 12. That's the yearly amount. Then you add all that other stuff, or subtract it. Subtract and add, then you get the effective gross income. My little summary.
I think.
Okay. Continue on.
Net operating income estimates. Net operating income is the income remaining after the allowance for vacancy and collection loss has been deducted. Miscellaneous income has been added, and that operating expenses have been subtracted. Potential gross income minus vacancy and collection loss plus miscellaneous income equals effective gross income minus operating expenses equals net operating income. Thus, when proper annual expenses are deducted from annual effective gross income, the result is annual net operating income. The net operating income is the amount of annual income remaining after the proper operating expenses have been deducted from the effective gross income, but before return on capital, return of capital, and property taxes have been deducted. The net operating income is the amount that typically is used with proper capitalization rates and procedures to arrive at a value conclusion. Net operating income, which is prior to the deduction of depreciation or adjustment for appreciation, is also known as gross cash flow. Operating expenses. After the effective gross income for the property has been estimated, the operating expenses must be analyzed. An analysis of an owner's operating statement is essential in determining proper and improper expenses related to the operation of the subject property. As mentioned previously, all the income and expenses shown by an accountant on an operating statement prepared for income tax purposes cannot be used in the income approach to value without careful analysis. The market rent may or may not coincide with the stated income. Also, only the reasonable and typical expenses necessary to support and maintain the income-producing capability of the property should be allowed. The value derived by the income approach assumes that the projected expenses will occur every year. Because of this inherent assumption, determining what expenses are allowable and at what level they occur is a critical step. Why are you pointing at me?
For emphasis.
Emphasis? You can't hear that on the recording though, my dear.
Okay.
Expenses for real estate, which are considered in the income approach to value, can be classified as 1. Fixed expenses, 2. Variable expenses, and 3. Reserves for replacement. The sum of these is referred to as operating expenses. Operating expenses are ordinary and typical expenses necessary to keep the property functional and rented competitively with other properties in the area. Reserves for replacement include annual charges for items that have relatively short lives, short-lived items, and that must be replaced before the end of the lease period or before the improvement reaches the end of its useful life. Operating expenses vary from property to property depending on type of occupancy, use type, and quality of management. In the analysis of the operating expenses for a property, the operating statements from comparable properties must be reviewed and the following questions considered. 1. Does the expense amount appear to be typical for the property in question, and is the amount sustained by expense statements of comparable properties? That didn't make sense. Does the expense amount appear to be typical for the property in question, and is the amount substantiated by expense statements of comparable properties? There it is. Substantiated is the right word.
Why don't you read the sentence above it in the analysis?
I already read that though.
Well, okay. Go ahead and read it again since you had a... Because these are the following questions we gotta...
Yeah, these are the questions that you have to be considered.
For what?
For reviewing operating statements from comparable properties.
Okay.
Does the expense amount appear to be typical for the property in question, and is the amount substantiated by expense statement of comparable property? Do the expenses tend to appear infrequently? Do the expenses appear to indicate typical management? Do the expenses indicate a specific weakness of the property in question, physical deterioration, functional obsolescence, or external obsolescence? Are the various reported expenses consistent as they relate to each other, maintenance, age, and reserves for replacement? Is the ratio of expenses to gross income comparable to those for competitive properties? These questions must be considered in analyzing expense items on an owner's operating statement because the assessor is predicting the stabilized annual net income that the property is expected to produce, assuming competent management in a typical year. Proper expenses. The following categories are examples of proper expenses related to the operation of a property. Management. Management is a proper expense for every income-producing property, regardless of whether it is owner or tenant occupied, and whether an actual management fee is paid. Management is usually stated as a percentage of effective gross income and varies depending on the geographic area of the property type. The charge for management typically is based on a percentage of the rent collected. The rate for the subject property must be determined on the basis of the conditions in the area and the typical charge for management for comparable properties. Included in the management charge may be accounting expenses, office expenses, rent collections, advertising, lease commissions, and coordination between management and other owners relating to all matters, including financial and personal management of the property. These may entail a management fee paid to a professional management firm. Such a fee is not to be confused with the salary of an on-site building manager, whose salary would be included in the expense category salaries. Salaries. This category consists of the salaries and fringe benefits for employees necessary to maintain the property and to provide the operational activities required to keep the property rented. Such employees would include resident and on-site managers, maintenance people, gardeners, security people, and other employees needed to keep the property physically, functionally, and economically competitive. Expenses for management staff include salaries, vacations, sick leave, annual leave, holidays, Social Security, health insurance, unemployment insurance, and the rent for apartments provided for employees who live on the property. Utilities. Included in this category are gas, water, electricity, sewer charge, fuel, telephone, and trash removal. Because utilities fluctuate from time to time, a careful review of expenses of comparable properties must be made to determine reasonable and typical utility expenses. Materials and supplies. In this category are expendable items used in the day-to-day operation of the property, such as office supplies, light bulbs, grass seed, fuses, and fertilizer. Repairs and maintenance. This category includes expenses necessary to keep the property operating and covers the repair of such items as the roof, water heaters, cooling systems, broken glass, and painting. This category should not be confused with reserves for replacement. Expenses in the category reserves for replacement are anticipated predetermined expenses with an annual charge set up for replacement. Repairs and maintenance, on the other hand, are normal maintenance expenses generated by the physical use of the property. Property taxes. Property taxes can be considered an expense item in the income approach. However, in appraising for assessment purposes, the preferred way of handling this item is to use an effective tax rate as part of the capitalization rate. See Chapter 13 and 14. Insurance. Insurance is a proper expense item that should be checked to ensure that the insurance coverage is adequate and the expense charged is for only 1 year. Many insurance premiums cover more than 1 year. In such cases, annual proration is necessary. Miscellaneous. Items in this category should be small ones that do not justify listing an amount to only a small percentage of the effective gross income. These items vary widely from property to property and should be examined in detail if the total is substantial. Reserves for replacement. Expense items in this category are similar to items that are depreciated in the cost approach as short-lived items. Parts of a building that normally must be replaced before the building reaches the end of its useful life should have an annual expense charge as a reserve for replacement. For example, if a property is under lease for 25 years, it is reasonable to expect that such items such as carpeting and air conditioning will wear out before the end of the lease. Therefore, reserves for replacements are set aside annually to provide for the eventual replacement of these items. Replacement items that can be included in this category are roof cover, water heaters, heating and air conditioning systems, elevators, floor coverings, stoves, dishwashers, and refrigerators. The amount of annual reserve for replacement to be set aside for any specific item is calculated in the following manner. Number 1, estimate the useful life of the item. Number 2, estimate the replacement cost new. Number 3, calculate the percentage of reserve per year by dividing 100% by the useful life of the item. Another way is to use the reciprocal of the economic life. The reciprocal of any number is 1 divided by the number. Multiply the replacement cost new by the percentage of reserve per year to arrive at the annual charge. For example, a small retail store has a remaining useful life of 40 years. The roof cover has a useful life of 20 years, and the cost of the roof to cover is $12,000. The annual percentage can be calculated as follows. 100% divided by 20 years equals 5% each year, or the reciprocal of 20 years, 1 divided by 20 is equal to 5%. The annual percentage is then multiplied by the cost of the roof to determine the proper reserve for the replacement charge for the roof. Cost of roof, $12,000. Cost percentage multiplied by the 0.055% equals an annual reserve for the roof of $600. Improper expenses. Because the income approach relies on accurate estimate of the net operating income the property will produce, it is important to accurately estimate all expenses to be deducted from the effective gross income. Several items found in an owner's operating statement are not proper expense charges in the income approach. Some of these improper expenses are as follows. Depreciation. Because in the income approach, depreciation and appreciation are considered as recapture and handled as part of the capitalization rate, this is an improper charge. Depreciation is usually included in operating statements for income tax purposes and is not necessarily the same as the recapture provision in the capitalization rate. Debt service. Debt service normally includes both the interest and the principal payments required to amortize the loan on the property. This item is considered in the capitalization. Income taxes. The income tax shown on the owner's operating statement is not an allowable expense in the income approach when the property is appraised, because the income tax is based on the individual personal income of the owner and not on the property value. Individuals and corporations pay income tax, whereas properties do not. However, when corporations or businesses, not the real estate, are appraised, income taxes are a valid expense because corporations and businesses do pay income taxes. Capital improvements. Capital improvements include additions to the property made at any time and not necessary to maintain the level of income at any given time. Capital improvements ordinarily result in an increase in the total value of the property, in the economic life of the property, in the income of the property, or in all three. Therefore, these expenditures are not considered annual charges and should not be deducted from the effective gross income when operating statements are reconstructed to calculate net operating income. However, when cash flows are to be estimated for a discounted cash flow analysis, capital expenditures can be deducted from the net operating income in the year the capital expenditure is expected to be made and not averaged on an annual basis. This is especially important when the net operating income estimate is based on the assumption that the capital expenditure will be made. Failure to deduct the capital expenditure in this instance results in an overstatement of value. The appraiser should consider the impact on highest and best use as capital expenditures are considered. Owner's business expenses. Don Tokabi. The owner's business expenses, which are not necessary for maintaining the rent produced by the property, are not proper expenses. Even though this type of expense may be permitted for income tax reporting, it is considered personal expense and not related to the income produced by rental property. In determining proper and improper expenses for a property, the assessor must compare current expenses with past year's expenses, compare the current expenses with those shown on statements of comparable properties, and interview the owner, manager, or accountant about expense items in question. I need a break.